India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Hello and welcome to a brand new week and a brand new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me as always is Nigel D'Souza. And today we have Rima with us to kickstart a week. I think last week was a hectic one. It was a heavy one.
Indeed. Major
events out of the way, and I think it's going to be very interesting, the direction and the route that our markets take. Morning, guys.
Hi, good morning. And it's a truncated week, guys.
And it's the end of earnings season as well.
It's the end of the earnings season.
And it's been quite an earnings season with a lot of disappointments. Yeah. After a while, we've seen this sort of an earnings season. But let's hope things shape up well from a bullish perspective as the week progresses.
Yeah, absolutely. I guess the bulls will be happy. I think I call it the week after. Like you have the morning after. Now this is the week after. You've had a lot of these heavy headlines and events. So if the bulls can manage to even continue in consolidation without cracking once again,
Indeed.
I think that would be something that people will take on board. So let's get started and let's take a look at how the setup is poised this morning. What we have is, once again, a very positive handover from Wall Street. So the Trump trade is still very much raging on. Whether you're looking at US equities or you're looking at the crypto markets, by the way, new headlines there literally on the hour on crypto. What happened on Friday was that we had all the key indices, the Dow, the S&P 500, Nasdaq, and the Russell 2000. They kept on notching more gains. The Russell once again was outperforming because that's been the biggest talking point, right? That how the next leg of the US rally is now going to be in the mid and small caps. And we've seen more evidence of that play out. So good handover coming in from Wall Street. Let's talk about what's been happening with yields and the dollar. Yeah, that's the picture. And we'll talk more about this as we go forward. The last huge big week that we had, the US markets put in anywhere between 5 to 9% gains. We managed to stay flat throughout it. So that's important context to keep in mind. We'll talk about it as we go forward. On the yields and on the dollar, yields cooled off quite a bit after that high drama midweek of 4.4% on the US 10-year. Now you're back to a more reasonable 4.3%. The dollar also has retreated a little bit, but it's not too far away from the recent highs, still very much around that 105 handle. So, now that we have the big central bank moves also done, BOE has cut, Fed has cut, and it's going to be more eyes on China. Speaking of China, the markets around our neighborhood are a little subdued today. In particular, China, it's very, very clear that this NPC disappointment is still playing out this morning as well. This $1.4 trillion or 10 trillion yuan package is not really lighting up the street. There is the Singles Day shopping event that's starting off. So I think that's going to be a very important track from just a retail demand perspective. And ahead of that, there's some red on Chinese markets this morning. For us, just to quickly complete the picture, the consolidation band, like we just contrasted our performance with Wall Street, where indices are up almost 5, 6, 7%. The Nifty has been range bound, and the bulls will hope that more consolidation is better than a fall. So the range of the consolidation between the lows and the high, we're talking about 23,800, 816 to be more precise. On the downside of the range, the upside of the range has been capped at 24,500. So net, we're talking about a 700-point trading range. As long as the downside doesn't break, I think the bulls will take that. Breaking it through the upside, of course, is something that we keep in mind. Lots of earnings to go over, and Rima and Nigel will talk more about that. It's a mixed bag as usual. Asian Paints was weak, Tata Motors was weak, but the company is sounding very, very optimistic. Ola's losses are reducing. So, and Divi's, some of the pharma numbers have been looking very, very good. So we'll keep going through the individual stock action. But at the headline level, I suppose it's very important for us not to break below last week's lows. So I'm going to watch out for the lows quite carefully this morning, Rima.
Indeed. The problem for our market is, on one hand, you've got earnings, not just misses, in some cases, howlers. Like Asian Paints, for instance, right? It's a broad-based, miss, right, from revenues to margins. And it's missed expectations by a very wide margin. Volumes have declined by 0.5%. And this is the first volume decline that we've seen since COVID. And there have been so many such instances. So Jefferies, I think there's a recent note where they say out of 121 companies that they cover, 63% of them have reported in their coverage, 63% have seen earnings downgrades. So that is one problem pocket for our market. Now, the question is whether the expected recovery in the second half plays out. And the second one is this consistent, persistent, massive FI selling. Last week, every single day, the FI sold and accumulating to nearly 19,500 crore. That was the extent of the FI selling last week. The DIIs were buyers. They bought about 15,000 crore as of last week. What will you watch today? As we said, it's a truncated week. Friday is a holiday on account of Guru Nanak Jayanti. So we've got 4 days of trade lined up over here. Today, big earnings from ONGC, Britannia, Hindalco, Shree Cement. Later on in this week, in the economic calendar for India, we also have the CPI print that will come out tomorrow, and US inflation print on Wednesday, and the retail sales on Friday. So now that the big, events are out of the way, the economic calendar is what
we go
folks
back
in
to
the US
following
will be
data,
going back.
Well, that's right. Just to build on to what you all said, the earnings season has definitely been a disappointment. Far more misses than hits. And in fact, there's been a scale down in the EPS estimates as well. But how much of this earnings disappointment is in the price with around an 8% correction on the Nifty? Well, we'll come to know about that. And also Asian Paints and Tata Motors, both of those numbers are very, very disappointing. But both the managements are guiding for a far better second half of the year. So will the street look to buy into this sort of a dip? The numbers are disappointing. So let's see how that plays out as well. The second factor is the Chinese stimulus was touted about. Everyone was talking about it, right? And that shift, the hot money that will move out of India into China. Now, the stimulus isn't as great. So will this FI selling slow down a little bit? For the last many sessions, there have been sellers. Can we see the quantum reduce? That will be a bit of a relief from a bullish perspective. So I'll keep an eye out on both those 2 points, earnings and the FI selling in the cash market. In the F&O market, they continue to add shorts. They added close to around 4,000 short contracts. And now the short positioning continues to hold above that 75% odd mark. You need some kind of good news to get these FI stumped. For the time being, they've been getting it right, actually, because they are holding on to those short positions. And the markets, in fact, have seen more or less a time-wise correction in the last few sessions or so. Now, in Friday's trading session, yes, the Nifty ended lower, but you had the VIX as well that did cool off in trade. And sometimes, that's the sign that maybe in the near term, you could see a bit of a bounce. I'll be clutching onto this data point as well. Moving to the options data, then we had 2 strikes that were very active. 24,200 call, fairly active, 14 lakh shares out there. And on the downside, the 24,100 put was active. The premium on both of them around 120 rupees. Plugging in this premium and the options data, we get the support and the resistance for the day. So this is just for the day, 23,950, and resistance comes in at around 24,350. That's the range for the day. But the bulls are counting on this level holding out, the 23,800. We almost visited that twice last week. So the bulls believe that this level at least can hold out. And HDFC Bank, we've been making this point, it has been a bit of an underperformer in the last 18 to 24 months. But even in Friday's trading session, that held one end up. That was up close to around 0.5% or thereabouts. Until it holds on to this 1,690 level, 1,700 odd level, you'll say that you'll have to back this one to fight for the bulls. And the Nifty Bank will be important because HDFC Bank, well, that's holding one end up. But the Nifty Bank, well, in Friday's trading session, it ended down close to around 0.7%. Now it has both the resistance zones up ahead of it, the 20 and the 50 DMA. So HDFC Bank can hold on to gains and hold more or less the flattish line and consolidate for a bit. The Nifty Bank, if it can fight back, it can get past those technical levels, which will give the bulls some ammunition to get closer to around the 24,500 odd mark. The GIFT Nifty suggesting 80-point downtick. I think at some point of time today, we see a bit of a recovery intraday.
Yeah, I guess we'll watch for that. And if indeed we can pick some green, because right now Asian screens are quite weak. By the way, Hong Kong market's down about 2.5%. Inflation numbers out of China are looking weak. The rise is, there's hardly a rise, 0.3% for the month gone by. So that's also in focus. Basically, China in 1 to 2.5%. That's the kind of decline that we're seeing in some of the China and the peripheral markets as well. Let's start the show then with the equity call of the morning. Mahesh Nadurkar of Jefferies says more than a fifth of stocks under Jefferies India coverage are trading below the June election results low, and 30% are down more than 20% from the 2024 peaks. He says a pickup in government spending, capex in the second half, improved seasonality, and somewhat better relative valuations mean that a potential short-term bounce back is possible in the market after the recent correction.